We have John Tabis on the podcast. John is a legend. He founded the Bouqs company, teaches at UCLA, and is a general partner at M13. You're a legend.
You like to call me that. I don't quite get it, but I appreciate it.
It's just exceptional. You've been on both sides of the table. You've been a founder raising over $50 million as a founder, and then moved to venture capital at M13, a $1 billion fund. And it's just exceptional. How's being on the other side of the table?
Yeah, I mean, I run the venture studio inside of the fund, so I almost sort of stand in both sides at the same time, right? I'm not just on the other side evaluating companies, writing checks, and I'm not just building. I'm doing a little bit of both, and so it is. I always say I'm not a real venture capitalist. I'm like venture capital light, where I ultimately have the decision-making capability to write a check. They're really small checks for our fund, $250,000 to $500,000. But really the work is helping founders, help them explore their concepts, build the right teams, build the right go-to-market strategies, and then ultimately attract funding.
Which side was your favorite? Being a founder, being a venture capitalist?
Oh gosh. So I would say that my most fulfilling period of my career was the first 2 years of Bouqs, where I was a founder, but it was the early days, right? And probably even really the first 18 months, where it's just purely creative. You never know what's going to happen. There's always action happening. That was magical for me because it was create, iterate, learn, create, iterate, learn. That was great. Being a founder from year 3 or 4 on was pretty miserable for me. I didn't like being a CEO of a team of 40, 75, 100. That was really hard. I wasn't great at it, and it wasn't as fun. So I really like that early founder journey stuff. So being on this side now and running a studio is a nice combination. It's a pretty good fit for me where I get that itch scratched, but I know that I don't have to scale the business over the next 7 years. So it's a really nice balance today.
So you're more 0 to 1 than 1 to N.
Correct, 100%.
So when you were in the 1 to N role, how different was that?
Oh, I mean, it's dramatically different, and it's not like it's an immediate switch. It's like a frog boiling, right? Like you don't know that the job is changing until the job has changed, and you haven't changed with it, and that's when pain happens. You do certain things early stage, you get rewarded for it, right? You get press, or you get money, or you grow revenue, like all these things, and then you try to do the same thing 2 years later, and you get penalized for it. Oh wait, why are you going rogue? Why aren't you putting it through a process? Why aren't you prioritizing your resources? All these things that are what CEOs do, not what founders do. And no one ever tells you, there's not a point in time where they go like, stop being a founder and be a CEO. You kind of have to figure this out on your way. So, anytime I invest in or I meet somebody who's going through that, call it Series B, C range, you sort of have to be ready for this pretty massive change in what the job is and know that you want to do that job and that you're capable of doing that job.
Going into founder mode.
100%. Well, out of founder mode. At that point, you're going to CEO mode. Right? I remember probably 2016 or something. I got a coach, and the coach was like, "Hey, here's how we measure the efficacy of our CEOs." And they had like 8 attributes, and they asked my team what I was good at, and asked me what I was good at. And I looked at them, and I was like, "Don't want to do it. Stink at it. Don't want to do it. Hate it. Okay, I'll do it if I have to." I was like, I don't like any of these. None of these are creative. None of these are about creating vision. And it was about managing a business. And that was the first time I thought, maybe I'm not meant to be the CEO of this business forever.
So Series B, Series C is around the time when you have that shift.
Yes. Well, I'm sure it depends on the company, but I think on average, that's probably a pretty good approximation.
So what was the first round for Bouqs, like a new founder, your first round?
Yeah, so I started fundraising, I remember it was yesterday, in the fall of 2012, winter of 2012. We had launched November 6th. We had done, $30,000 of revenue. And I knew nothing about raising money, literally nothing. And I'd come from the Walt Disney Company, right? Massive company, 200,000 employees in corporate strategy. And so in my head, like this was all kind of muckety-muck. Like you didn't need to worry about professionalism or process because it was like, this is the world of startups. Like we shoot from the hip, it's all fine. And so I called the one VC whose phone number I had, who was at Polaris. And I'm trying to raise like $1 million seed, pre-seed, whatever you want to call it. And I call a late stage, like Series C and beyond manager. And I'm like, hey, I want to raise money for you. He's like, that's not how this works. You should really look. And I had to spend some time educating myself about what's early stage, what's mid stage, what's late stage. and the types of checks and the type of people I should be approaching for those checks. And then I got some introductions and I started having calls. And I remember I was talking to like First Round, like a really, even back then, a really well-known, high-quality firm. And I was doing the pitch while I was on my phone, walking my dog and my 9-month-old son around the neighborhood. And I lived in Venice Beach, which is not a quiet town, right? Sirens, people, cars. And I look back on it and I was like, oh, I was so just completely clueless. I had no idea. So that first 6 weeks of trying to raise money at the end of 2012, I effectively just stopped it and said, like, I need to learn how to do this. I need to get my business further along. And I stopped in January, February, March of 2013. I just ran the business and we got to like, I think we did like $40,000 for Valentine's Day or something like that. It's like, whoa, 40 grand. Like, we're a big business now. And we ended up doing 2 million in that first year. But it was like this big shift of focus on the business and then learn how to fundraise. So I called friends who had raised money, learned about the process, learned about what to do, what not to do, got feedback on my deck. My first deck had literally no design in it. And my good buddy Andy Dunn, who had founded Bonobos, was like, you're supposed to be some brand guy and this is your deck? Like, it's like a PowerPoint with no pictures, no color. You're a flower company, like reflect the brand. And I was like, I didn't know any of this stuff. So it was really a big learning experience. We slogged along and got a couple $100,000 from angels committed, but they were waiting for a bigger check. And then we got a $200,000 sort of micro VC check, and then $400,000 check after that kind of came together as a $1.7 million note at a $4 million cap. Oh, which looking back on it was stupid, but it's what we could raise at the time. E-commerce was really out of favor. There were a bunch of flameouts that had just happened. So it was super dilutive for us, but it gave us a shot.
Yeah, dilution sounds crazy.
Brutal. It was absolutely brutal. But, valuations were very different 12 years ago. And the category at the time was not hot. And look, a round at that point was way better than not a round.
Yeah.
Right. And those investors ended up being crucial through our Series A and have been supportive sort of along the way. So, you build a company that's worth a couple $100 million, even if you take dilution early, it's gonna work out.
Yeah, it's almost like something of 100 million is a lot more than everything of $1 million.
That's right. I mean, look, I want founders to own as much as they can own, but often founders, they hyper optimize around the smallest things in the cap table in the early days. And the reality is like, if you get a shot with a couple $1 million to build your thing, every round is less dilutive than the previous from an absolute dollar value perspective. But it's hard to have that point of view when you're like, wait a second, before this round, I owned 60% or 80% or 100% of this business, and now I'm going to own 45 or 28 or whatever it is. It feels really massive because it is. Yeah. But I think there's definitely a lack of education around what that curve looks like in terms of how much you're going to actually get diluted on a dollar value basis over time. And so people hyper optimize around it, and sometimes they really lose great deals, and then those deals don't come back around. So I would always say, like, look, if you're going to give up an extra 2, 3, 5, 10% of your business, or you're going to get it done, it's easily worth it.
Is that one of the biggest mistakes you see with founders even today?
I think so. I mean, it's a little different now, right? I mean, now you're either raising or you're not. And if you're raising, you're probably getting a pretty great deal because valuations have spiked so much. And, it's hard to get deals done today, but the ones that do get done are typically pretty competitive. People are fighting for your deal because it's a really great deal. It's sort of a flight to quality in today's market. So, it is a little bit different of a beast, but still certainly that natural instinct to be like, how can I give up this much of the business for only this much money is still out there.
So now moving from your early round to a later round, like when it started becoming more number backed, like how different was, say, a Series A, Series B compared to your original round?
Yeah, I mean, it was different, but I wouldn't call it massively different. The inherent wisdom that I got from others was like, hey, be very intentional about who you pitch. Do it in order from least desirable to most desirable. So you practice on those that you want the money from the least. Have a tight timeline on when you're going to close. I wasn't good at any of that. Like that structure and process, I believe it's probably the best way to raise money, but I wasn't good at it. So what I did was I just pitched to everybody that would listen. I did hundreds of pitches, and it takes me generally about 130 pitches to get a deal done. I learned that's what the number is on average across Series Seed, A, B, C, and then C pluses, plus what I do now. It just takes volume. Like you have to kiss a lot of frogs to find your prince. And I found that works for me. I wouldn't say that it's necessarily the most efficient. I wouldn't say that it's necessarily the best. But I raised $83 million for the Bouqs company plus $20 million of debt. I'd raised $17 million for a fund that ended up not coming together, and then I ended up working at M13. So I think it works for me, right? What I would say for people in terms of process and style is like figure out what your process is. Take in all the advice, learn from others, but then figure out, how you meld that into what's going to work for you and your business.
So there's so much persistence in that.
Yes. No problems with no's. No, you're either winning or learning, right? There's no losing in this ever. And it Bouqs is now a 12-year journey. If somebody tells me tomorrow that Bouqs will not be a billion-dollar brand, I'm just like, you're wrong. And you could look at different parts of our journey up and down and left and right and lots of different dynamics. And it fundamentally will be the largest flower brand ever created. I know it. Why? Because it's a better business than the other flower brands that have been created. It is not an opinion. It is not subjective. When you look at the metrics, you look at the way the customers respond, you look at gross margin, you look at LTV to CAC, every single metric, we're the best that's ever been created. So it's just a matter of time. It's not a matter of if. And we've proven that, right? It's a 12-year journey so far. We're a profitable business when no one can get profitable. We're a 9-figure business when no one can crack 10, 20, 30 million in top line. It's been slower than we all wanted. It hasn't been the up and to the right straight line rocket ship that everyone would love to have. But as we talked about the other day, that's pretty rare, right? Like that's the exception, not the rule, even though those are the ones that get celebrated. Like, oh my gosh, we built $1 billion valuation in 4 years, raising $20 million. Like, nice, that's amazing. That's not the way most companies get built.
I admire that. That's amazing. Just building a great product and at the core, building great value.
That's right. That's right. And look, if you build something that has staying power for generations, you will be financially rewarded. But more than that, you've done something that matters. Like the number of people that when in my current role at M13 find out that I'm the founder of Bouqs and go, no way, I gave my grandmother a subscription for 4 years. And then she passed away last year. It was one of her favorite things every month for 4 years before she died. That's way more. That's way more reward than you're going to get through any other piece of building a business that matters. Whether it's software, a product, a brand, an agency, like the impact you can have on people's lives and the fact that that's even an opportunity is ridiculous. Like what else can we hope for in a lifetime than to get stories like that, right? And I literally got one of those stories this week. I can't believe you're the founder of Bouqs. Let me tell you this journey I had with my grandmother. And like we had some small part in enabling that. That's a pretty amazing thing to do.
That's fantastic. I think at the core, business is just about building more value for the world.
Yep, 100%. And this is what, when we talk about, our grandiose vision at M13 and at Launchpad and even for Bouqs, is like if you're aiming for financial outcomes, you're probably never going to get them, right? It's too narrow. And it ends up, frankly, like leading to tactical decisions that will stymie your potential. Whereas if you're aiming for something bigger that people can get rallied around, that is meaningful with or without the returns, you get the returns, right? And that was our day one in Bouqs. We were like, there's a better mousetrap here, and that's interesting. But there's really just a better customer experience and more meaning that's capable in this category. So let's aim for that. And with the studio at M13, Launchpad, we're like, there's a better way to help founders build. And we looked at all the models. Like we've seen how people deploy capital, the services they provide, et cetera. And we took just a very heavily founder-centric approach because we feel like that's the magic. You find a great founder, you match it with a great problem to solve, and you support the heck out of them. And that is, to us, feels very good. It feels very noble, and it attracts people to it because it is a good cause.
So move to your role as a fund manager. When you look at startups, but with per se your framework of building a company, seeing a company to do so much scaling, when you see other founders on the same journey, what's your perspective talking to them?
Yeah, it's great for me personally. So selfishly, I really love it because the problems that you face are super intellectually challenging and very interesting. But you're not sitting in the seat with the weight of the world on your shoulders. You can have a little bit of a step back and kind of appreciate it for what it is, and then hopefully bring some value to that founder as well. So I personally really enjoy it. But then you look for the same things, the same traits, the same approach that got you through all those ups and downs along the way. And this sort of, no give up, no quit, grit sort of idea is often very much at the core of it, because you can have the best idea, the best go-to-market advantage, tons of money, and things are going to hit the fan along the way, whether you want them to or not. And being able to work through that, you're talking about earlier, like helping founders be prepared for the eventual storm that will come is super important. And, not a thing that happened a decade ago when I started my business. Not a thing that often happens for founders today. Because it's, hey, if you're a winner, we're on your side. If you're a loser, we write you off and we move on, right? For us as co-founding entity with a lot of the companies that we build as Launchpad, we are common share owners. We are literally incented by the same thing as the founder. So if the founder cares about it, we care about it, right? If it's the wrong round, if it's the wrong potential commercial partnership, if it's the wrong hire, we're sitting there, side by side with them, thinking through the same lens as them.
So you said common stock owner, not preferred stock.
Well, it's both, ultimately. So the way that I think about what we do is we'll get an idea without a founder. We'll get a founder without an idea. We'll get a team with no founder. Like, we'll get all these pieces of a puzzle, but it's not the full puzzle when it comes to us. And it could be anything: technology, go-to-market, cash, all the stuff. And we help fill the gaps. So in that first 6 to 18 months, we're alongside the founder, filling the gaps in what their go-to-market plan is, what building their business looks like. And for that, we get some portion of common ownership. If we do a ton of money, take a ton of risk and a ton of time, we'll own more, but never more than 30%. If somebody brings us something that's more baked and we're spending less time, less money, less risk, we might own 15%, but never less than 15% of the common, because we're providing way more than capital. And we'll do that work on our dollar, on our time, without a guaranteed check. And if we don't write a check, we don't take any of the common. So if we don't get to a point where we're convicted enough to write a $250,000, $500,000 first money in, then we didn't do enough to get it to a place where we believe to write a check. Then we didn't do enough to earn the common. So the common goes back to the founder. They take all of our work. It's free for them. The company is theirs. We have no ownership, no rights to that business. But we have the right to write a preferred check. And so we write those $250,000 to $500,000 checks first money in.
What's the like building that model? That's not the most conventional model by any respect. What was the thesis behind designing that model? Was it like, how much of it was based on being a founder?
Yep. It was both what's best for the founder and what's best for the fund. And what we found was that those two absolutely 100% align, right? It's not great for a founder to say to somebody like, yeah, I'm going to give you 20% of my company, and maybe you're going to add value, right? That's a terrible feeling. You're like, wait a second, why am I giving this away when I don't know what I'm going to get? So if we get to the end of our process and we're writing a check, that means the founder believes in the vision that we've pulled together, the resources we've pulled together, and then therefore wants a check from us and wants us to be a co-owner of the business. If we don't get to that point, then they don't want it and we don't want it, right? And so our incentives are 100% aligned. What we can't do is we can't spend 6 months, tens of thousands of dollars, and all of our opportunity cost time, and then not have economics for that time and effort. And so this is really a nice balance, which recreates what happens in the wild outside of our petri dish anyway. What happens out there? Founder has an idea, they start talking to friends, one of their friends joins, great, now we're working together on this thing, but there's no clear path to capital. You're sort of spending your time wondering. We can be that sort of accelerator of that process, make it happen faster, more efficiently, land more likely at a place that will get liftoff, and do it sometimes where a founder has a full-time job. We call those founders in waiting. Like, oh, you work at Microsoft, you're making $700,000 a year, but you want to build a company someday. You're not going to quit tomorrow, go to a garage and hope. But you can work alongside of us. Sorry, Microsoft. My buddy Hans runs Microsoft for Startups. We're not stealing your people, Hans. But if there's somebody who really wants to do this out of a job, we can build alongside of them, have them really de-risk their own personal journey, and get it to a place where it has a couple $1 million in the bank before they quit. And so it really balances, the needs of the individual human being that is also a founder with the studio.
It's so interesting because we're so wired to think that business means high risk, which it often doesn't. It oftentimes means a lot of commitment, a lot of grit, a lot of going at it, but it oftentimes is more smart risk rather than high risk.
100%. Like, there's tons of ways to mitigate risk, especially early on, right? Like, I think everyone thinks it's, hey, I got to spend 3 years making $0 and hope that I get to a product that has some product market fit. It's like, well, maybe you can shorten that time frame. Maybe you can find other ways to have income. Maybe you can work with a studio who can take some of that lift off of your plate and get you to a place of more conviction before you quit your job. There's lots of ways to sort of dance around the inherent risk. And honestly, when you think about ROI of time, I say this over and over and over again. I think trying to start a business and failing is some of the best ROI you'll get in your life because you've learned so much. You've made so many more connections than you ever would have before. And this community, even in LA, well, especially in LA, is small, which means you've built tendrils into a lot of people you would have never met otherwise. And those people often go on to build massive things. And then guess what? They hire you or they invest in you from their new fund. Or like the trickle down effect of relationship in this world is pretty amazing and I think very unique. Because as long as the ecosystem that you're in is producing winners, that produces capital, capital attracts more opportunities, and the cycle repeats itself. So there's very little downside to trying something. That doesn't mean you don't have to be or you shouldn't be smart about how you try it, though, right? There are absolutely smart ways to mitigate the risk.
That's so true because it really is a small world.
100%. I mean, it's crazy to me how often, like I just got connected with an investor and I found out just upon checking the LinkedIn that they worked at Bain & Company in Chicago 2 years after me. We have like 25 mutual friends. And then they worked at Amazon with one of the folks on the Bouqs team. So they're good friends. And it's like these tendrils happen really fast at scale, especially in communities like LA Tech, which has grown a ton, but it's still not big. You're not talking about 100,000, 500,000 people here. Like you can get to sort of 6 degrees of separation with one relationship in LA Tech, and that's a good thing. That's a really good thing because you can build community so much faster.
That's very, like, I moved here about 3 years ago, and it's such an intimate, it's like oftentimes from the outside community, the startup community seems a lot more reserved, but it's a very inclusive community. Everyone knows the bloodshed and the sweat that it takes, and is supportive to it too.
100%. I mean, there are different flavors, right? Certainly New York is different from LA, is different from the Valley, et cetera. But I think you're right, that core sort of bond of understanding what it is you're signing up for and why, and the same DNA of dreaming really breaks down a lot of barriers pretty quickly, right? If you walk into a convention in some other industry, there's a certain vibe, and it doesn't matter what industry it is, there is a vibe. And in the startup world, it's very convivial, it's very collaborative, it's very open because everyone knows that you're all going through it together. Whether you're an investor or a founder or an operator that's going to join a company, everyone knows what we're all signing up for, which is a lot of pain for the chance to build something that matters. And that's, for at least the people in this world, a trade-off that's worthwhile.
Absolutely, almost altruistic. Building out again.
I don't know if I'd go that far.
I know, I would probably pull back at this point, but I tend to go too deep into many of these rabbit holes. But it's fantastic. It's a very intimate community, and it's awesome because it's entrepreneurship at its core is quite lonely.
100%. Yeah, and that's what's great about having this kind of community around you is the opportunities to not be. And it's one of the biggest things that we push at Launchpad. You know, some people ask like, why would I work with a studio and give up X% of the equity? I don't need it, I don't whatever. It's like, if you don't need it, you don't believe that that's the best model for you, you should not do it, right? I would not say that working with a studio or an accelerator or whatever is the right path for everyone. But I've been very pleasantly surprised that of our founders that we've backed, 50% of them have been at least second-time founders. So they've been through the journey, they know what it's like when they go it solo, and they don't want to this time. And by the way, if I were to start a company again, I would never do it as a solo founder. Like I had a co-founder, but he was in Ecuador. And so he ran supply chain from Ecuador. I saw him, the first time I ever saw my co-founder was probably in year 3. So we didn't have enough money to fly him up from South America, right? And so you don't want to go it alone if you can avoid it. And this is a really easy way, relatively speaking, to bring partnership and shared understanding and resources to that journey instead of really just trying to figure it all out. And it doesn't mean that people can't figure it out. It just means that you'll figure it out a lot faster and have some shortcuts that make it a lot less painful.
That's beautifully phrased. What's the biggest mistakes you see founders make?
I mean, in our practice, I would say most of the time where we start to sort of differ in strategic vision is that and this is not a bad thing for founders, by the way, it's actually a really good thing. We want to find the best set of resources before we go out to try to attract capital that's outside of our own. We want to feel really good about the team that we have, the technology approach that we have, the go-to-market, and what our co-investment looks like. And often founders are like itching to go. They're like, but I just want to build. And that's really good. Again, I'm not saying that's a bad thing, But when we sort of get to a place where it's like we're just not going the same place, that tends to be what it is, which is like we can fill in more gaps before we go full foot on the gas here, because you really only get one shot to sell the steak, right? You're sitting at dinner, the steak is put in front of you, you take your first bite. If that bite's not amazing, the steak's just not great, and it's really hard to raise money for a not great steak. But everything before that is anticipation. You're just thinking about like, oh, my fillet is going to come out here with this on, and it's going to be so amazing, and these are my sides. And you have a choice. Before you do anything with a product, you're selling the sizzle. And the sizzle can be anything because no one's ever experienced it before. And once you build something, that is gone. And so this sort of trade-off between what's the right strategy, and I'm not saying it's always right to sell the sizzle, not the steak, but often it is. And founders want to go build the steak because it's their dream, it's their baby, they just want to see it exist. But our point of view sometimes is like, let's spend 3 months making sure it's the best version of that we can possibly build. And often I'm not saying that's a mistake, that's just where we most often have difference of opinion.
It's interesting, like a problem I think I find myself making, a mistake I made multiple times is just trying to solve a problem, but falling in love with the solution, not the problem.
Yeah, 100%. I mean, we all get blinders in our lives, whether it's about personal relationships, the way we raise our kids, how we eat, whatever it is. We get accustomed to a certain way of thinking, and it's really hard to break outside of it, right? And exactly what you said, I've done, I think every founder has done to some extent in their journey, right? But I think this happened for us once at Bouqs. This is probably like year, I don't know, 4, 5, 6, something like that, where we had gotten to a place where the sort of purest version of our model, drop shipping from a farm in South America, just didn't work to satisfy the customer needs. It was too slow. They wanted a different type of presentation, whatever it was. And we started having these conversations about like, hey, we're gonna bring the same product in, and we're gonna put it in a warehouse for 2 days, not 30 days, not 15 days like the market, 2 days, and we're gonna reship it out. And for some people, that was the last straw. They were like, how can we do this? This is not our mission. Our mission is straight from the farm, always straight from the farm. That's what we're here to do. And I was like, we can do that, and we can do that really well, and we will bring sustainable flowers to 1% to 2% of the market, which is not completing the mission. It's very pure, but it's not changing the industry, right? 1% of market share is not going to change anything. To change it, we have to be a massive player. And the way we have to do that is evolve this model logistically to stay true to the same things, straight from the farm sourcing, sustainably grown, fresh, blah, 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 but without limiting ourselves to a certain almost like adherence with no context to an idea. And some people left. They just could not handle that this was an evolution of the concept. And frankly, I struggled with it for a while too. I was like, I see this is where we're going, but this is really upsetting because this is not what we thought it was going to be. But I literally had a presentation that said we can be purely this and be really small, and we can feel really great about it, or we can change the way this thing works for good, and we're going for this one.
So such decisions, like that's where I think a venture studio really makes a difference, because first-time founders, it's just really hard to make a decision that might just change the future of your company when you really don't have a reference frame beyond your intuition.
Yep, 100%. And we can be that, again, very economically aligned, but more broadly and comprehensively experienced resource. So we have myself, Andrew, and Amaya on my team. We have our set of experiences, but we also have 12 partners across the firm, 45 employees who all worked at scaled startups, invested in scaled startups, and seen this playbook so many times that when you're dealing with a certain situation, I have to fire my COO. He's the most senior person in the firm, has been in this industry for 20 years, but is culturally toxic. I can't fire that person. Everyone believes in that person, this and that and the other thing. We've all seen it 7, 10, 20 times. And so we can bring that context like, look, it feels like it's the end of the world, but here's 3 examples where it actually turned out really great for the business, and help bring that context for the founder.
Those things are scary, and they just sound so scary.
They are scary. The whole journey is scary, right? And this is, I think, the part that I'm most passionate about. Is it is a journey of grind, and it is every day, and the weight does not feel like it's on the company's shoulders, it feels like it's on yours. And the company failing doesn't feel like the company failing, it feels like you're failing. And especially for people that are highly driven and highly successful in their lives up to that point, that can be psychologically not an option. Like, if I can't fail, I have to make this work. And that's a pretty difficult place to be, right? If you're spending every day with limited resources and you have to succeed, it's not a very healthy place, right? But that's where founders often find themselves. And one of my sort of personal passion areas around this space and what I work on at M13 is founder mental health, founder emotional health, founder physical health, and professional health. And like, how do we think about providing resources, access, and just an open forum for founders to talk about that in a way that isn't judgmental, that isn't scary, because, you know, you're a founder, you've raised 10, 5, $50 million, and you have a board that's counting on you. The last thing you want to do is say to them like, hey, I'm having a mental breakdown here. Like that's not a thing founders want to say. So you need to have a place to go where you can get resources and help. And we hope that over time we can become a firm and a launchpad that provides a lot of that.
It's so interesting because this is one of the most unique parts of business I noticed, because I worked I've built small things, but in different markets, whether it's India, whether it's here, and a few different markets, but it's the challenges of business are very similar everywhere. Like, I remember the first time I had to fire someone, and it being the person was really toxic to the business, but I had hired the person, so it was really hard.
Yeah, some of those things, you know, you think about them kind of in a mental way, like you're evaluating it when you're outside of it and you're watching somebody else do it, or I would do it better than that, or I wouldn't do it that way. And then you find that it's in front of you, and your stomach clenches up and you start to sweat, and it's a very uncomfortable thing to be the person that made the mistake of hiring the wrong person, and then that person has to pay for your mistake, right? They didn't hire them, we did, right? As the founder, the CEO, the manager, we hired them. That's our fault. We put the wrong person in the wrong team, in the wrong situation, or whatever it might be, and we have to own that. That's very uncomfortable. And now you have to tell somebody else really bad news that's your fault. That's tough, right? That's really tough. And doing it with grace and doing it with the right message around this is the best for everyone here, and having the other side believe it is tough, right? It's a tough lesson to learn. And I think these, again, are the things that we hope to be able to help empower founders to do well, better for them, better for the business over time, because you just got a bunch of people around you that have reps. Like, I've seen this play before.
So you work with now at M13. You get like this. You're like a serial founder at this point, working with so many companies. So now at M13, when you're building so many companies concurrently and working with so many companies, what's your way of looking at the business models, looking at next steps?
Yeah, I mean, I've always said I never understood. I respect, but never understood specialists. Like, if you told me that I could have had a life where I became a Olympic gold medal gymnast, I would be like, I don't want it. Because that meant every day I did the same thing over and over and over and over again until I perfected it. And I can't handle that. My brain can't handle it. My body can't handle it. Like, if you told me that I could be the lead guitarist in a rock band that went global and I had to tour for 40 years playing the same songs over and over, I'd be like, no thanks, I'm out. Like, I can't do it. I would love it for like a year, 2, 5 years, whatever, and then I would be bored out of my mind. And so what I love about the job is that it is this multiple companies at different stages, multiple challenges all at once, and that pivoting of the brain from one problem to another problem, from one person to another person, is what makes it super fun. The way that I think about it generally is, let's just hone in on what is the biggest key driver of this business, and let's just focus on that. Because there's a million things you could talk about every day about any business. But what's the thing that's going to get it from an idea to an investable business, or from an investable business to a more investable business, or from an invested business to a scaled business? And let's just focus on the 1, 2, or 3 things that, if we achieve that, will unlock that business for good. It might be a person challenge, it might be a distribution challenge, it might be a technological challenge. That almost doesn't matter. And my job is not necessarily to come up with the answer, it's to build the process and the resources to help the team get to those answers as fast as humanly possible. The biggest challenge really is, you know, a year ago we had 1 investment. Now we have 5, and we're working on 4 more. Pretty soon we're gonna have 9. How do you split your time when you're a team of 3 to optimally help 9 businesses? And the hope is, well, 2 of them will, you don't hope, but 2 of them will fail. It's just gonna happen. 2 of them will get seed rounds, which now they become our propulsion team, which is the largest portion of our organization. That then they become the consultants. So now we're back down to 5. And if we can keep that flywheel happening, where we're winning or learning over and over and over again, we can keep it in a wheelhouse that we can manage. And then the hope, frankly, is a couple of them just go, whoo, like that, and they raise $50 million, and they're way past us. We're there as friends and as mentors and as as common shareholders to give them the right advice, etc. But they're on to large funds that are backing them in Series B, C, D, and on down the line.
It's exceptional because you get to see the journey and be a part of so many different journeys.
Yes, it's also heartbreaking when it doesn't work, and because we're never going to bat 1,000, right? No one does. We hope that we're batting 500, 600, 700. That would be an amazing outcome. But when it doesn't work, and you've all sort of aligned around, hey, we see this vision, and it can happen, it really hurts. We're pretty early right now. We don't really have any of those in our portfolio yet. But over time, it's certainly going to happen, right? And I've watched my company go through ups and downs. Friends' companies completely fail and shut down. Hey, I'm looking for a gig. I built this thing. It didn't quite work out. And it's, that realization and that ability to sort of refire up the spirit and try again is an incredibly noble and shocking thing that people sign up for multiple shots on goal at this. But it's what's needed, right? We always have to learn from the things that didn't work and go and apply those learnings to the next one. So it is very fun. It is not easy, but I honestly say to people all the time, I think I have one of the best jobs in the world.
I love that. So within M13 and the whole fund's outlook, given the size of the fund, it's almost like you're a startup funding startups within a fund.
Exactly. I say it all the time. We're building a machine while the machine is flying or driving, whatever you say, to build machines. And if it works really well, we should be in service to our fund and the community in a way that drives outsized returns for our investors and for the fund overall, right? And also, hopefully, drives a lot of value for the founders as human beings and as founders, and for the ecosystem around M13. We're the sort of tip of the spear. We're meeting people a year before they found something, 3 months before they found something, as they're founding something, whereas the fund generally focuses at Series A. So we're earlier in the process. We can be a funnel for talent, for ideas, for concepts, for those existing portfolio companies, for the fund to invest in later. But really, it's, we say all the time, the thing that makes M13 magic is the ecosystem that we've built. The connections, the capabilities that we can bring to bear on our companies and on the Series A companies that we invest in. And so, even in a world where we don't find the next unicorn this year, although I think we have a couple that have a really good shot, we're creating value for the ecosystem, for the founder, and for the firm.
It reminds me of a movie in AI, machines building machines.
Yep, yep. It is really what we're trying to create, right? What is the right version of this process that is scalable but still human, right? There's lots of studios that bring in management teams after they've poured $15 million and effectively have the product stood up, and they're like, okay, you come in and now run this thing. I'm not saying that model is wrong. I have no idea if it is. I've spent no time doing that. But what I know for us is that the founder is the fundamental piece. And that means we're going to kiss some frogs that don't work out. Not saying they're frogs, but it's not a fit for us, whatever that might be. They raise money too fast from other people. They don't want to build it the way we want to build it. They don't have the skill set to build the company. We think somebody else should build it with them. They don't want to. There's lots of ways that those dynamics won't work out. But as long as the process gives us enough shots on goal to match up right with the right founders, we're going to be doing the right things.
When you're dealing with a founder who's still very early and figuring out whether they should go a certain route or go a different route, should they bootstrap, should they raise? What would be some? It's very hard to generalize, but what would be some key areas you think they should deeply think through? Yeah, I mean, the way we start, and we actually do this work with and for founders all the time, is we just learn about the space, whatever it is. They're building AI insurance product. Okay, let's do a full market map. Let's understand what the TAM is, who the competitors are, who's been funded, who hasn't been funded, what shut down, why. Lots of sort of exploratory base level understanding. And I don't know what percentage of the time, but some percentage of the time we get to a place where we're like, oh, this space just doesn't make sense for the solution that you're trying to come up with. 4 people have tried it. They all fizzled out between seed and A, whatever it is, right? Other times we say, oh, this is great. We've learned something here, but let's pivot a little bit to this area because we see white space, because we see your skill set fitting, whatever it might be. And as we do that, we talk to experts in the space, folks who have built, who have had success. They might be an operator at a scaled startup. They might be at a large incumbent. They might be an LP in our fund, like whatever it is. But these people bring unique insight, connections, and ecosystem in that given space. And one of 2 things are going to happen as we have that conversation. Either they're going to say, wow, this is amazing. How can I get involved? Or they're not. And if they're not, and that happens 7 times in a row, it ain't the right company, right? You in the wild, like I said before, you get people together, resources start to coalesce, momentum starts to happen, or it doesn't.
And so the same thing with us, we're just recreating what happens in the wild. We're just doing it faster, more efficiently, with intention, and with resources that a founder wouldn't have otherwise. And so as we have those conversations out there with all these experts in these spaces, if we're not starting to get more and more of them saying, can I invest? Can I be on the board? Can I be on the board of advisors? Can I run it? Then we know we're in the wrong space, or we're with the wrong thesis. And then we, sort of shuffle the deck and come back again and come back again. And then eventually we go, this thing doesn't have it, parking lot it, try another one. And that, that founder that brought us that idea might, disagree with us, and they might still take all that work and go build the business, or they might agree, and then they might say, hey, oh, by the way, I saw that you were building this thing over here in automotive. I love that space. Can I talk to that founder? Yeah. Oh, now I have a COO, right? And this sort of mishmashing, the combinations happen all the time, where I expected to come in and work on this. I met this person, and now I'm the co-founder or the advisor or the investor to this over here, and that's really the ecosystem at its best.
I love that. So asking a lot of questions, meeting more people, and just finding synergies that don't exist, being very curious.
Yeah, 100%. And look, people are always like, should I tell anybody about my company? Should I keep it a secret? It's like, there's no way to judge whether anything's any good if it's just in your head, right? And so I say all the time, proselytize, like let people know, pitch it to everybody, and just see what they say. If they love, to a man, everyone loves it, you're probably onto something. Right? And then maybe eventually you'll find that you're not, but it's a pretty good litmus test. Like, oh, here's a product. I love it. I would totally buy that product. Can I please invest in it? That's a very clear signal to you. And especially if you get it repeat, you see a pattern, you're kind of like, wow, 75% of people love this thing. I should probably build it. Oh, 5% of people love it, but I'm going to build it anyway. That's where the blinders come in, right? And hopefully this process helps eliminate some of those mistakes.
It's interesting, those blinders, it's so important to get rid of them, but it's just thinking whether you're the Steve Jobs who's come up with this
the thing. Yeah, it's strong convictions, very strong convictions, incredibly loosely held. You have to fully believe, fully back, be ready to literally throw yourself onto the train tracks for this thing until you shouldn't.
Yeah.
And the hardest thing is, well, when should you shouldn't? That's not a science. There's no way to know that for sure. It's a combination of your intuition as a founder, the feedback that you get from the market, what your viable sort of options are, so what opportunity costs are there. I mean, I look back on, when I started Bouqs, within the 6 months prior to starting Bouqs, I had a very deep conversation with Meta, at the time Facebook, and I would have been like employee like 300, something like that. It would have gone pretty darn well, right? But I had a mortgage, I had a 9-month-old baby. They wanted me to move up to the valley. And I was like, ugh, like I got this startup job that's going to pay me a much better salary. And we just bought this house. It was like too much, right? And then I was like, okay, so that's not the right opportunity. What is? And these moments of trade-off will happen in all of our careers. And that context is really important, right? We had a founder just the other day who we were talking to for a while. And he was like, look, I would love to keep working on this. I got to go take this job. It's just too good of an opportunity. I'm like, we get it. We'll keep working on it anyway. Right? Maybe down the line you become the chairman of the board and we put another CEO in there, or maybe it takes us 2 years to get it to fruition, and then you're ready to leave that job to be the CEO. All these paths are possible, and that flexibility and sort of optionality is a core part of getting the best people to buy in. If you say like, hey, you have to join this, you have to do this, you have to do that, whatever, people have lives. Like you can't just assume that this can all happen in a vacuum exactly precisely the way that you want. And so a key part of what we offer is this flexibility to build in a way that works. And that's why I think founders like, if you think about it, there's so many millions of people who could be amazing founders who never will be. Why? It's the wrong time. They don't have the right idea. They never met a technical co-founder. But the capability is 100% there. They just never got the shot. If you build a studio, which we're doing, to give those people a shot, how much talent do you unlock in the world over time? If you can be a beacon of like, hey, it is possible for you to do this, you bring a lot of people off the sidelines who right now think like, oh, I work at a Fortune 500 company. To be a founder, I have to quit and make $0 for 3 years, and sort of dispel that myth and give them the resources to do it in parallel. It's a pretty amazing value proposition.
I love that. Strong convictions, but again, the best people, because it's amazing. Like the differential of someone who's really good and someone who's good.
Yep. And by the way, it's figuring that out is often the process of building is how you find that out. And that's part of what we do in this early stage. You might have someone who you're like, ooh, I feel they're really great, and you work with them for 3 months, and at the end of it, you're like, not the right fit, right? At least not for that role. Or you find somebody you're like, I don't know if this is going to work out, and they end up amazing. Like, you just don't know until you start doing the work. Do they have a flexible enough thinking? Can they attract people and resources to the project? Are those convictions very strong but loosely held enough? Right? All these questions get answered as you start building together. And by the way, they do the same evaluation of us. Are these great people? Will they help me build this business in the right way? Do they have the resources they say they have? And that's why this flexible model of engagement we think is the right way to go, so that everybody at the end of that process, which is really the beginning of the company, when we write that check, feel really good about it at that moment.
Testing the assumptions. It's so easy to be in an echo chamber in a vacuum.
Yep. And all those same principles of building a startup, test, iterate, learn, we just do in the Launchpad. We're doing it with individual concepts, and we're doing it with our entire process every day. I'm in love with that line now. Strong convictions, loosely held. Yeah, I didn't make it up, so I can't trademark that one. That was somebody else.
It puts it in such good perspective.
Yeah, it's a key tenet, I think, that people should hold, and I think in today's world, a highly polarized world, in the way we believe, the way we communicate, etc., there's a lot of super strongly held convictions that are pretty uninformed. And so I think we could all use a little dose of humility. I say this all the time when we invest in companies, when we help build companies, like, we're probably wrong a lot of the time, right? We're probably wrong. And that's okay, because humans are wrong. As long as we're right enough and our economics make sense for our LPs, then we've earned the right to try again and get better.
Absolutely. Any parting advice?
No, you can find us at m13.co/launchpad if you want to check out our incubation venture studio efforts. And then if you want to buy flowers, Bouqs.com, Bouqs.com, and you can find me on LinkedIn, John Tabis, Tabis.
And we'll link everything in the description.
Awesome. Appreciate it.